Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we are back again, like it or not. I've got we got a lot of stuff to talk about. It is phenomenal to see that out of all the investable stocks, what are investable stocks? See, a mutual fund, and by the way, mutual funds and exchange-traded funds, they control an abnormally large percentage of the dollars that are invested in the stock market today. So individual investors, much, much smaller. The institutional investors, not quite as big as the mutual fund and ETF industry combined. Close, but not quite as big. And the institutional investors act a lot like mutual funds anyway. So there's not a lot that these guys can do in stocks that are smaller than $250 million. So if you screen all the stocks by $250 million, you know what I just realized? I didn't tell anybody anything about what I was going to talk about this morning. I just opened up, start talking. I will come back to that later because we do have a lot of good stuff to talk about later in the show. Mainly the upcoming workshop. This is a very exciting time for me. It's very difficult for me to contain my enthusiasm because of what I'm seeing in the stock market, and it kind of plays right into that 250 million, just what we were just talking about. Why do you want to be paying attention? Because right now, the number of stocks that are big enough to be purchased by a mutual fund without having to jump through all kinds of hoops with the SEC and basically tell the entire world what their intentions are, which means everybody else jumps into those stocks and drive the share prices up before they can get a full position in the company. Okay, so they kind of stay away from that. And if you look at just the institutional investable stocks with more than $250 million in market value, there are a little over 3,000 of them. And out of that 3,000, 2 out of 3, it's over 2,000 now, are in a short-term uptrend. That has not existed for an incredibly long time period. That has not existed since before 2008. And think about that for a second. You've had some pretty good runs in the market where that never existed. And so that's why I'm excited about it. I don't think this, you're going to get corrections. The market could drop 10%, no sweat. That's normal. Okay. But I think the longer term view, the next 3, 4, 5 years, they're going to be really good years. And I think you need to try to get positioned to take advantage of that, which is why we're doing this seminar coming up in January. Actually, it's going to have 2 parts to it, by the way. The second part, which starts at 7:30, is going to talk about the risks and opportunities that are present in today's market and what may happen under the Trump administration. And that should be exciting, actually, because I'll tell you what, his policies are very, very, very pro-business. Whatever you think about him personally, he likes business. And he does like to win. Obviously, that's actually a good thing. But there are going to be some opportunities that are coming along there, and those things are starting to move now. They're starting to move now. I know everybody's looking at these going, oh, it's going to correct because it's all gone up. They always say that. The market's always going to crash. Somebody's always saying that. Eventually, when a crash does occur, because it's a natural part of the market's history, it's the way the markets work, eventually they'll be right. But it's not going to be a crash that ends all to be off. That were going to happen. It would have happened this last time around because that was a big one. That was a doozy. You really did a lot of severe financial damage to companies that took a long time to recover from. Now, the good news is it takes a long time to learn how to do. It takes a long time for the people that caused that to forget about how they did it. They remember that. It's seared into their memories. So they're probably going to avoid doing that again. It'll take a whole nother generation, generally, to come up with a new mistake. And it'll happen again one day. But I think that day's probably 5 years out. And if you look at the late 1970s, very similar to what we've come through here, except they had a different problem. They had inflation. Debt to GDP was a lot lower. They didn't have that problem. And they had super high interest rates. And the stock market did wonderfully. Look at how well it did from 1982 to 1987. And even if you took the crash in 1987, if you had invested in January, closed your eyes in 1987 and opened them in January of 1988, you would have actually been slightly positive, despite the fact that the market dropped 20% in a day and was down 35% from its yearly high at one point in time during the year. Reason to have an advisor or somebody, if you're out there doing this on your own, that gets pretty spooky, really spooky. And you need somebody with a long-term perspective to talk to occasionally and say, hey, help me. Give me some good news. Tell me what I need to look for, because you know what? And this is another thing, another story. I realize I'm doing the same thing I do every week. I'm drifting all over the place. But one thought always leads me to another thought or another memory. And I remember when I was really young in the business, there was a guy and a very successful stockbroker, because that's what he was. That's what we were back in those days. And he came up, I didn't know it, but he made it a point to talk to all the new people, and he pointed me in the right direction. And I'll never forget what he said. I knew at that point in time that in 1970, there was a 20% drop. That was a pretty big drop. In 1972 and 1973, the S&P dropped over 50%. The NASDAQ dropped 67%. Sound familiar? But that hadn't happened. You hadn't had those size of corrections. Even the drop in 1987, that one recovered very quickly. Hadn't had a drop of that magnitude for an extremely long time period. It was over 20 years. And so I asked him, and in fact, he invited me to lunch, so we're going to lunch. He points me in the direction of a couple books. And I asked him how he made it through the 1973-74. What did you do? And he basically was a value investor, and that's, so pay attention to value. He said the 1972-73 wasn't as hard because he was buying stocks that weren't overpriced. And they really didn't get hurt too much when the markets collapsed in 1972. So a little bit of skill, a little bit of luck. He would admit that. Everybody that's ever done that admits it. And he said the 1969-70 correction was significantly harder. Because that was more broad. The 1972-73 thing was very similar to the year 2000, when it was really a handful of sectors that went down a lot and gave the appearance that most stocks were going down, when in fact, a lot of stocks were actually going up. So anyway, I'll never forget the one comment that he made, and that is, Bill, you always have to be a little bit bullish. And I'm pretty sure he didn't remember my name was Bullington, but so I'm always a little bit bullish, no matter what. But I'll never forget that. That stuck with me. It's been almost 30 years now. I still remember that conversation like it was yesterday. Bill, you always need to be a little bit bullish. And he was telling me like he was telling me a really great, revered secret. And then throughout the studying that I've done over the years, I understand exactly why he was saying that. And he's right. He's absolutely right. You always need to be a little bit bullish, because I'm telling you, there are things that are being unleashed in the economy right now. Right now. The growth is going to come from there. The growth that you saw back when people didn't know what a car phone was, it was Well, nobody had a car phone. They didn't call them cell phones. They called them car phones because my first phone was mounted in my car. It was fixed, a fixture in my car. And I can't tell you how much money I used to spend back then. I know it was over $300 a month because I needed it. But and it was a legitimate business expense because I traveled quite a bit. And $300 a month back in those days would be the equivalent, I don't know, about $800 a month in today's day. That's a big cell phone bill, by the way. But anyway, that grew. Cable. I remember when they were just putting the lines in for cable. In fact, city where I live, they're putting in 100 gigabit per second internet, which is unbelievably fast, by the way. No one's ever going to have to wait for anything. It'll load up instantaneously like it was on your own computer. And this is my whole city. And yeah, they were kind enough to rupture a gas line when they were putting it in. And we all had to evacuate. There were like 4 city blocks. Everybody had to evacuate. You should have heard the noise that made. I couldn't believe. What is that noise? It sounded like this giant hissing sound. You could hear it through the walls in your house. And so yeah, they had to evacuate 4 city blocks. Anyway, that's what it reminds me of is cable. And today, you have satellites, you have internet coming over the cable. Nobody remembers that stuff. Nobody remembers how many people were employed by that. Yeah, that's a big deal because, and by the way, when I talked about a cell phone that you'd actually be able to watch video on, people thought I was nuts. They thought I was nuts because it was 1996 and nobody had ever heard of that. Okay? And it's not something that, some great secret. These things are published in various places if you have the time to read them. If you have time to read and go through, you would know these things. You would absolutely. Not a great secret. In fact, the internet makes it a lot easier in some respects. By that I mean the information is available, but in other respects it's harder because there's so much information, and it's very difficult to find out which sources of information are reliable and which ones aren't. Because there are a lot of unreliable sources out there that look very proper, very prim and proper, look like they're telling the truth, and quite frankly, it takes you a long time to figure out that they're not. So that's a challenge. We didn't have that challenge. Yeah, well, actually, yes, we did. So it's a little bit easier from the standpoint of you can get good quality information. Identifying it takes an enormous amount of time just because of the sheer volume. And that's why I'm doing these seminars. The seminars are fun, first of all. Clients get to come to them. So a lot of clients that I wouldn't see more than once a year can come to a workshop. Sometimes I have clients that never, I'm wondering if I would recognize them. They just don't come in. And some of them like to come to the workshops. If you're new, come to the workshop. Investing is it's the second most important thing that you can do financially. And financial planning, incidentally, is not as complicated as you think it is. You got to learn to live beneath your means. That's a bear. I don't care who you are. It's tough to do. You got to learn to live with beneath your means. And then you have to learn how to be a reasonably good investor. You don't have to be fantastic, just above average, which is very difficult. And if everybody starts being above average, the average is going to creep higher. It's going to get harder. Right now, the average investor is not hard to beat. That's not hard at all. And hopefully after listening to my radio program, they'll get better, and it'll be a lot harder to beat them in the future. That would make me feel good, by the way, because I see the situation that we're in this country. People have undersaved. They're going to have to work a lot longer than they thought they were going to have to work. And their lifestyles are not going to be what they had envisioned because nobody's telling them the things I'm telling you. Think about this. Well, actually, I'll come back to that later. But anyway, I'm trying to find my my workshop here, and I even forgot what date it was. But if you go to my website, bullingtoncapital.com, it's right there, and I actually Googled it. There we go. They got a fast connect. Well, this is my connection, actually. I have a mobile connection to the internet. It's got military-grade encryption on it, so and it's really fast, too. And here we are, January 12th, So it's January 12th. That's Thursday. The first part, which we just started the seminar before last, I didn't do it at the last one, but I'm going to do it again this one, is individual stock talk. We'll talk about individual stocks. Some of the stocks that I see, some of the concepts that I use in managing. I manage a small fund, by the way, in addition to the other assets we're managing. I'm going to talk about some of those techniques. That's at 6:30. We'll do that for about 40 minutes or so. We'll take a little break. The part 2, and this is funny. Somebody wrote on my website, they wrote Park 2. So part 2 starts at 7:30, and that's going to be New Year, New President, New Risks and Opportunities. We're going to talk about the things that look like are going to be put in place. We're going to talk about the impact that can have and the opportunities that's going to create in some industries and the risks that it'll create in others. That's important, I think, to know. There's no cost to attend. And we always, Tri-Cities Corporate College is a great place to go to host these meetings. Plenty of seating there. We take a room that has more seats than we actually have tickets for, so that you're not too crowded. So if by that point in time you look up and it says there are no seats remaining, then just call us, because typically there are seats remaining. But we just try to do that so that, just like I do everything, plan for the worst, hope for the best kind of thing. So anyway, that's bullingtoncapital.com. Go there. New year, new president, new risks and opportunities. And I got to tell you, I like what I'm seeing. I really like what I'm seeing. It's exciting. You needed the cell phone business, the cell phone industry to come along and create jobs. You know how many people just drive down a street in some major city somewhere or some smaller city? Go down and look at the number of Verizon stores there are, the number of AT&T stores there are, number of Sprint stores there are. You know how many people work for those companies? You know how much revenue and revenue that generates in this country? It's huge, astronomical. The cable industry, as frustrating as it is, it still supplies a tremendous number of jobs. And I got these guys talking about selling cable advertising, running their cable ads on my television, and they're talking about selling ads and jobs that pay 6 figures. I'm sure you're going to be hustling to make that kind of money. Anybody that makes that kind of money hustles. I mean, it's a lot of work. But think about that. That didn't exist in the 70s. That wasn't around in the 50s or the 60s. When we come back, I'll talk about why that's going to continue and how you might be able to take advantage of it. Thanks. You're listening to Bill Bullington right here on 1420. Stay tuned. Yeah, we're back. Listen to Bill Bullington right here on 1420 The Answer every Saturday morning from 11 to noon. You can also pick up this. If you missed something, you can go to my website. We copy the show. It's there for download. And you can go to iTunes. We're on iTunes. And we're on YouTube, actually. You can't see me, but you can hear the voice on YouTube. So if you hear something here that you really like and you missed it, don't worry about it. You can also email me. Sometimes that's a lot easier. Bill@bullingtoncapital.com. I'll be glad to respond to that. But I got to tell you, I am really enthusiastic. The more I look into what's happening, the more enthusiastic I'm getting. I've been doing this for an incredibly long time period, and there are certain things that you look for in an economy to kind of give you an early signal that better things are to come. And those signals are flashing like crazy. And I'm not going to talk about those today. I'll talk about that next week, okay? Because I have some other things I want to talk about today. Yeah, but we will come up to those early signals in the economy. I'll even, at the workshop, I'm going to show you how you can follow that if you would like to. There's a service out there called Y Charts, and I don't know if we're going to be able to manage a discount for people that listen to the show or not. I'll see, but that's what we're working on. We're trying to get a discount for it. They've changed their pricing structure too. I use the professional version, and it's kind of expensive. It's a fraction of what I pay for the Bloomberg, by the way, and it's a little easier to use, which is amazing. I'm stuck in my Bloomberg contract, though. I can't get out of it yet. But when I can, I'll be using Y charts. So anyway, I'll be showing that at the seminar too. The seminars are a blast, by the way. A lot of good stuff going to come out of those. A lot of good things that have come out of them in the past. Anybody that's been investing with me, especially over the past couple of years, I've been talking about the MLPs and have been investing in them, and it's been a rough ride. At first, actually, it was very good. Had a great first year. Oil prices tanked. They sold those stocks in sympathy, and because they're so much smaller, it doesn't take a lot of selling to drive their prices down. They went down a lot. They're not that far away from recovering because we've been reinvesting our dividends. And I'm telling you right now, those sectors are the average yield on it's right around between 5 and 6% tax-free. Where are you going to get that? Incidentally, the entire time that oil prices were getting crushed, the overall revenue for the pipeline industry went up, was up over 10% in a horrible environment. Think about that. A 10% increase in a crappy environment. The environment is improving, particularly for those. And here's something that you may have missed in the workshops, and I'm going to take the blame for that. I didn't emphasize it enough. The vast majority of the pipelines, well, not the vast majority, about 50% actually. 50% are doing almost exclusively natural gas. And the ones that do petroleum and natural gas get a significant amount of revenue from the natural gas. They don't get it based on the price of natural gas. They get it on the volume, the number of cubic feet that they push through the lines. That's how they get paid. There are a couple of, actually, look at Investors Business Daily. They put a nice weekly version of it out at the end of the week if you don't want to read it every day during the week. There's a great story on it. And this is happening. It's coming. And one of the reasons Russia has been creating so much noise and it has so many problems, the price of natural gas has come down so low because there is an abundance of it. Wait until we start exporting to Europe and watch what happens. That's going to be very interesting, but keep your eyes peeled. But in the meantime, natural gas has surpassed coal as the leading generator for electricity. It burns a lot cleaner. A natural gas plant can be put up a lot closer than a coal plant can to the distribution centers. The distribution centers actually can be put closer to the consumption. That's what I meant to say. So, and why is that important? Well, because when you transmit electricity over long lines, it loses some of the power along the way. So a lot more money required to generate the same electricity. Makes common sense, right? And we are under serviced in that area. So it's still got a lot of growth. Natural gas is still gaining ground on coal and other resources. By the way, natural gas is used in a ton of things. It's used in paint. There's a component of natural gas that gets used in paint. So it's petroleum. There's a component of it that gets used in plastics. Plastic. Most of the plastic has some ties to natural gas in it. So it's I think it's kind of an easy one. Come to the seminar, I'll tell you what we're doing. We actually had an exchange-traded note that was called from Credit Suisse. Put out a letter. The position disappeared for a day or two, scared everybody. Like, no. They're just cashing it in. The transaction closed. The balances have shown up last night in all the account values. So if you're a client, you can breathe a sigh of relief now. Because they thought they thought that money had disappeared. This is it's just a technicality. And they closed this, by the way, because an exchange-traded note, they did that for tax reasons. Because in an ETF, there's a higher tax rate than there is in an exchange-traded note. But an exchange-traded note is actually considered a liability on a bank's balance sheet, and Credit Suisse wanted to clean it up. They wanted to reduce their liabilities, so they closed the fund. It was extremely profitable, too. That's what's really wild. That was extremely profitable. So they closed it down. If you're a client, we have others. Morgan Stanley's got them, or we can buy the portfolio, because I still think this is a really good thing to have in your portfolios, at least some amount. Some amount. I don't know if you've been in it as long as I have. You're going, most people are thinking, hey, you've lost your mind. They really thought I lost my mind about 8 months ago when it was near its bottom. Yeah, it's only more than doubled since then, by the way. But when I got started, I'm just almost back in the black. But I have a lot more shares than I had, because I've been reinvesting the dividends all the way down, and I've been buying more shares on top of that. So if you look at my a total cost basis, probably at a break even right now. I haven't looked at it in the last couple of weeks. But the bottom line is, this is a big deal. I think this is going to be very good over the next few years. And reminds me of when they deregulated the utilities. Utility stocks, they went down 75%. The index went down 75%. Deregulation. Everybody ran for the hills because suddenly everybody's going to start selling electricity right out of their backyards. Except that they forgot. To generate electricity, you need a big old plant. And you need the transmission lines to do it too. So the deregulating of the utilities, it panicked everybody. They sold. Those things went down. The index went down 75%. And then when they figured out, oh, yeah, we forgot. It takes a lot of money to build an electric power plant. And I'm not talking about a little bit of a lot of money. I'm talking about hundreds of millions, kind of a lot of money. So the deregulation really didn't do all that much to the industry, because there's such a high hurdle to get in it to begin with. Now, if it had been something like oatmeal, then yeah. But oatmeal's always been deregulated, by the way. And Quaker Oats has done quite fine, quite nicely. So that's where you, if you're looking at value investing, I think the old-fashioned buy stuff when nobody else wants it. Well, people still have a really bad taste in their mouths over the MLPs, which is probably a good thing, because when they love them, it's going to be too late. They're going to love them because they're up a lot. That's what happens. And it's going to be too late. The easy money is going to be gone. When the yield on that index gets below 3%, the gig is up. The yield right now is, depending on the index that you're in, is between 5 and 6%. So if the yield goes down to 3%, it's because the share prices have doubled. Or every one of the companies in the entire industry has cut their dividend in half, which is highly unlikely because they haven't cut them in half in the last 2 years. So if they haven't cut them in half yet, the chances of them doing going forward, pretty remote. Does that make sense? Anyway, you know what? I forgot to give out the phone number today, 216-901-0945, 216-901-0945. If you want to call in and ask a question, you can always email me, bill@bullingtoncapital.com, if you'd like to. I can't always get to it on the radio at that point in time. I'll try if I can, but you can also, I will try to email you back. If you have a question, you can always email me there. This is important stuff. The markets really have not done that well. When you look at the stocks that have done well over the past 2.5 years, they're these big, giant companies that really haven't made a lot of money. They and the average small and mid cap stock had gotten crushed. I mean, at one point in time last year, small cap index was down 25%. Why wasn't anybody talking about that except for me? I'm not sure. Yeah, I'm really not sure why that is. I have suspicions, but I can't verify it, so I just won't say anything. But a lot of stocks really got beat up, and they were really hurt in a lot of industries. Those industries are coming back now. You've got an administration that is old school a little bit, and those old school industries have taken it on the chin, and they're taking some actions to help them out. And you can see it in the share prices. Stocks are moving. Stocks are finally moving. And there's some old economy stocks that are moving like they're technology stocks. I mean, they're flying. Okay? So, and they're in the portfolios. Our high dividend model, it's got some of those in there. Those ones that are. Did you see GM? That was crazy. The General Motors, I thought, holy cow. I wouldn't own those stocks if they didn't fall into a certain criteria. And that GM since July is up 28%. Since July. That's pretty wild. When Trump got in or won the election, that stock shot up like a technology stock. It's amazing. It goes up 20% in a week. Big GM. So that's pretty interesting. And I'm not a big fan. I wouldn't own it, by the way, if it didn't fall into one of my models. It met a certain criteria that got it in, and that's how that works. So typically I wouldn't own a stock like that. And I only point that out because GM is not what you'd consider on the cutting edge of technology, although they do employ a lot of it in their cars. And that's going to be a big deal. It's not going to help the car manufacturers as much as it is the companies that are making the components that go in those cars. That's where you want to look. IBD Weekly for this weekend, right on the front. Read that article, 5G and the Need for Speed. It starts to explain a little bit about what's going on. 5G is much, much, much faster. If you're going to have self-driving cars, they're going to need speed. The speed. Can you imagine having a self-driving car? It's hooked up to the internet that times out. Not good. So that's going to be necessary. And the board operator and I were talking about during the commercial about all the changes that come in the last 20 years. And man, it's fascinating because I'm a lot older than he is. And I remember when we had a black and white television, no color television, black and white. I remember having the remote control was me. My dad would go up and say, hey, go up and change the channel. I'd have to stay there and change the channels until he saw a show that he wanted to watch. And he didn't ask. My dad's a super nice guy. He would just ask if I would go do it. And I would go do it. I didn't really mind because you only had 5 channels. It didn't take long to get through all 5 channels. And that was it. 5 channels. And by the way, the television looked like a piece of furniture. It was built in a big wooden box, looked like a cabinet. Yeah. So yeah, things have changed quite a bit. Nothing is as constant as change. Change is coming a little faster now. And these changes are very good. Electric cars, I used to talk a lot about that. They're here. They're doing very well. We still don't have the infrastructure in place really to switch over to that completely. That's coming. And that's the funny part about this is you talk about these things. If you read a lot, you find out about things that are in development. They don't come as fast as you'd like them to. And making money from those observations is a lot more difficult. You actually need to add an element of timing there. There's an element of timing that you need to add to it. It's one of the reasons we have a momentum model. Timing is the primary function in that model. And again, we'll be talking about that at the next workshop that's coming up because that's an important thing. All these things that I'm talking about in my favorite models are built to capture those movements when they come. There's still stocks. They're still going to fluctuate a lot sometimes. We'll talk about that fluctuation when we come back from these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. Hey, I just was reminded, I forgot to give the phone number out here. If you'd like to call and ask a question, 216-901-0945. 216-901-0945. And I did get an email and was asking me about a fund, symbol UGAZ. And it's a natural gas, and it's 3 times It'll go up more than 3 times what natural gas. Well, actually, I shouldn't say that. It's leveraged 3 times. So whatever the movement in natural gas is, it's supposed to be. Its goal is to be 3 times larger than that. For an average person, I say stay away. Don't do that. If you're going to trade the fund, then trade it. Use a 20-day Donchian channel on it, and it just broke above that. Your stop would be $20. That's a long way away from $38, so don't put a lot of money in it. And that's what I would do if I were going to do that. Now, personally, I won't do it. Commodities are very, very difficult. The 3 times long, they're buying futures contracts, or potentially they could be buying options on futures contracts. And the internal costs inside of something like that are enormous. You don't see those. Those are not management fees. They're built into the products that they're buying inside that fund. The products that they're putting in the fund have huge costs to them. They call them carrying costs. There's a price for volatility that's factored in there. It's extremely expensive. And you know what? Maybe I'll do some research this week and come up with a way of investing in that, because I do think natural gas is probably going to go significantly higher over the next couple of years. Lots of reasons for that. In fact, again, this weekend's Investors Business Daily, I normally I don't get a whole lot out of the Investors Business. I typically get more out of Barron's than I do that, but this weekend it's completely reversed. There's an awful lot of stuff in Investors Business Daily I think is spot on. So the IBD Weekly, you can pick it up on most of your Barnes & Nobles. So it's a very good story there about natural gas, the demand for it. This is one of the areas I think is going to be really fascinating. You got Trump in office. He hasn't talked much about natural gas or pipelines. I have a feeling the deregulation part, he doesn't like regulations. Republicans in general don't like too much regulation. I got to agree with them. I think you need some regulations, and you need to make sure people are playing fairly. They're not cheating. But you can go too far with that, which I'm pretty sure has been happening and really resulted in the election results. So there's too many regs. People got tired of it because it was slowing everything down. Slowing everything down when you put 1,000-page documents up there, and people have to take a couple weeks just to read it. That slows things down. So that's a part of what we'll be talking about at the upcoming workshop. And hey, how'd you like how I tied that in? That's just kidding. And here I go again. Computer's giving me problems. Anyway, part 1 starts at 6:30. This is going to be January 12th. That's a Thursday. So right at the beginning of the year, we'll get cranking and start talking about some individual stocks. How am I identifying these things? By the way, if you're a momentum investor, the past 3 years have been brutal for you. I know, because I run a lot of money using momentum strategies. It's not just me. I mean, it's everybody in the industry that does that. The market conditions have not been conducive to that. They've been very conducive over the last month. That's a change. That's a change from the last 3 years. I'll show you how I identify that change. It's pretty simple. I'll show you how I identify the change in the first part at the individual stock talk. Second part of the seminar is going to start at 7:30. We'll take a break between the two, so if you don't want to come to one or the other, you can either leave or come in late. So suit yourself. Take my advice. Do what you want. We're going to be talking about the new year, new president, new risks and opportunities. I'm really happy with some of the selections that he's made, especially on the financial side. The financial side I'm really excited about. I think it's going to work out really, really well. I know some of the other posts people are kind of upset about. And you know what? If you get the economy going, people won't be as upset. And it's been picking up. And I'm sure I'll probably take credit for that. Even though it started happening before he even got in. It started happening before the election. But I think it was a little too late in happening. And it's one of the reasons that he got in. People got tired. They're worn out. are looking for a change. They're looking for an acceleration. And I understand. People are impatient. I get it. Yeah, it's part of my business. People get impatient, especially when the market chops along. Especially when you have big corrections that nobody seems to talk about. But anyway, if you'd have a question that you'd like to email me, it's bill@bullingtoncapital.com. You go to my website at Bullington Capital. You can just reach out in the contact form there. In fact, that's where I got the question regarding the long natural gas. Personally, if you want to make money on natural gas, it's hard to do. I recommended doing this a couple of years ago because natural gas prices had dropped significantly. It looked like they were rallying a little bit. And they did rally a little bit right before they turned around and went right back down. And that's the tough thing about these commodities, or anything really. It's very difficult to get the timing down. And I'm going to show you how we do that with most of the momentum-based portfolios at that workshop, because those strategies are probably going to start working again. They haven't worked very well for 3 or 4 years. In fact, Marcico, the guy that used to run a couple of the big Janus funds that everybody was so in love with back in the early 90s, and they did very well. He got up to $100 billion in assets with his own firm. Now he's down to 3.5 because his style's been out of favor. He's not doing anything differently than he did before. The market conditions just haven't been conducive to that particular style. And true to form, most people give up on something right before it's about to work again. There's a really good story along those lines that from, I forget what the fund name is. I'll have to look it up. I'll bring it up next week. Anyway, this fund manager writes a book, What Works on Wall Street, opens a fund shop using some of the strategies that he had backtested and researched. And they fell out of favor as soon as he opened the funds. They stayed out of favor for about 3 years. He sells the funds. They come back in favor and become the top performing funds in their categories. That's just the way it works. Why? Because they're stocks. That's what stocks do. They frustrate you. Why do I talk about stocks so much? Well, I talk about stocks so much because right now, there's nothing to talk about in the bond market. I mean, there's nothing. I remember a guy I think it was somewhere a little over a year ago. Actually, I think it was, I think it was probably a little more than a little over a year ago. This guy was talking about, I remember. It was the end of 2014. And the guy calls in to this show, and he's all happy, because he invested in this TLT. That's an ETF that invests in 20-year treasuries. And it had done very well in 2014. And if you measured actually over the year, that thing was up almost 30%. And he called in during the middle of the year. It was up about 15 or 20%. And he was really happy about it because I was talking about it not being a really good investment, because 30-year treasuries, when interest rates are really low, at some point in time, tend to go down a lot. So the price around when he was calling was about 115, and that was in 2014. And now, after getting up as high as 140, by the way, it got to 140 and came back down to 119, goes back to 140, so gives you a false sense of hope twice. Now it's down to 119 again. So now you've gone 2 years, and you've made about 1.5% a year if you held on to it. Woohoo! Yeah, isn't that what you want to do? And people wonder. It's amazing. It's just amazing. I wish I could explain this stuff better. I think we'll be able to going forward, because we've got our light board done. That's actually a big pane of glass that's in a frame. And a lot of the stuff that I'm talking about, it's very difficult to form a mental picture of what it looks like. But I can draw it on the glass and record it and pop a video up, and you can see it. So not only will you get the explanation, you'll get the drawings. my hieroglyphics actually, but you'll be able to go back and look at that and review it. These things are not rocket science. None of this is rocket science. How did I know that at some point in time, 30-year bond's going to go down? Well, because when interest rates are the lowest they've been in over 100 years, you figure at some point in time, they might go up, maybe a little. In the meantime, trying to figure out when they're going to go up, good luck. Good luck. And you just keep trying it. Okay, so at any rate, let's see. And I hold a lot of high-yield bonds. By the way, here's the difference between high-yield bonds, which I was holding back at that point in time. They're down too. They're down about the same amount, actually. But their income was so high that there's not a loss in it if you were reinvesting your dividends. Think about that for a second. Actually, think about that until next week, because that music means the show's over. Thanks for listening, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good luck, and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.